So the stock market looks like it's collapsing with no bottom in sight, and we have yet another down week in the markets. But something interesting happened. If you look at the S&P 500, it went within the bear market territory again. Remember, a bear market is officially when the market closes 20% below the peak. So it went 20% below the peak, and some of the news media were already calling, okay, a bear market is started, bear market is started. But interestingly, before the market closed on Friday, it closed back above that 20% level, narrowly avoiding that official bear market term in the S&P 500. So it's kind of like the market's teasing us, right? It's like bear market, no bear market, no bear market. We'll see what's going to happen. But it formed a pattern which is known as a classic bear trap. A bear trap. What's a bear trap? A bear trap is when the market looks like it's going into a bear market, and when it went below that 20% mark, a lot of traders went short, right? They started shorting the market over here. And at the last moment, the market kind of like trapped them and closed back above that 20% mark. So if the market rallies next week, these bears that went short are going to get killed. That's what we call that, a bear trap. So what's the chances of that happening? We're going to take a look in a short while. So that's the S&P 500. Now, if you look at the NASDAQ, we had that same pattern, except for the NASDAQ, it's already been in a bear market for quite a while. But we also had, right, it's 20% below the peak. In fact, it's now like down, close to 30% below the peak. And again, we had that bear trap pattern, right? Went below, people went short, closed back above. And we'll see what that means in a short while. Now, if you take a look at the media, there were two interesting points that was made, right? Number one, the Dow Jones is on its longest weekly losing streak since 1923. That's almost 100 years. So if you look at the Dow Jones, it has gone down for 8 weeks in a row, 8 weekly bearish candles. And that's the longest losing streak since 1923. So it's a pretty historic moment, right? How about the NASDAQ? The NASDAQ and the S&P have had 7 red weekly candles in a row, 7 weekly declines in a row, and it's the longest losing streak since the dot-com crash back in 2000. So the market is so extremely bearish that I'm actually getting really bullish, and I expect a very strong rally in the markets within the next couple of days. Now, before you're thinking, Adam, what are you smoking? Are you high? No, I'm not. Right? So you have to understand that the market is kind of like a pendulum. It swings from one extreme to another extreme. And it's such that when the market gets really bearish, that's when it turns bullish. Once it gets really bullish, that's when it turns bearish. So what evidence is there the market is kind of like reaching a tipping point where it's going to flip over? Well, there are a couple of things that I'm looking at. The first thing I'm looking at is the fear and greed index. And right now, we are at the extreme fear level. And historically, every time the fear and greed index goes into extreme fear, it has always marked turning points in the market where the market tends to flip back upwards. So that's one thing. The second thing is if you look at the Williams percentage R, or you can look at the stochastics or RSI, on the weekly basis is again at extremely oversold levels, as you can see. And this again has always coincided with market reversal bottoms, right? Right now we are here. So again, this is another sign that we are deeply oversold, market's extremely bearish, and there are signs that the market is gonna flip really, really soon. Now in trading, you don't just look at one indicator, one pattern that gets you to form a thesis to go long, to go short. You look at multiple indicators or signals and you're building a confluence case where many signals tell you the same thing, the probability is a lot higher. So number one, we are oversold in the markets. We are at extreme fear levels, and something interesting has happened as well. If you take a look at the S&P 500 as well as the NASDAQ, you will see divergence between the price going down and the advance and decline line. So the advance and decline line measures the number of stocks advancing versus the stocks declining. And for the first time, the advance and decline line is going up when the market has gone down. So that's a very, very interesting development. Now, if you take a look at the S&P 500, and again, The same thing is happening on the NASDAQ as well, right? So notice that, again, look at this advanced decline line. Notice that when the market went down from here, it made a new low over here. The advanced decline line went down as well, right? When it went down from here, this low, to this low, the advanced decline line went down as well. Okay, so every time the market went down, there are more decliners than advancers, all right? Whereas in this recent week, although the market went lower, but the advanced decline line for the first time during this correction is actually going higher. So in other words, below the hood, you can see that there are stocks that are actually gaining. There are more gainers than decliners, and we call this a level of divergence in the market, which again could be another point of confluence that the market is going to start reversing soon. Now, the 10-year yield in a way has been the market's expectations of inflation. So because of high inflation, the 10-year yield has been rising. Now, the moment the 10-year yield starts to come down, it's telling you that the market is beginning to see inflation come back down. Once inflation comes back down and the Fed doesn't have to raise rates as aggressively, the market will have a huge change in sentiment. Now, if you take a look at a 10-year yield, you notice that it's beginning to look like it's topping off. So long term, you can see this resistance on the 10-year yield, right? And it broke above that trending resistance, but there's a very strong horizontal resistance over here. Now, if you take a look at what has happened last week, you notice that we hit that level of resistance and we actually closed with two bearish candles on the 10-year yields, on the weekly candles, right? And this looks really overbought. So if this comes down, which I suspect you start to come down, that would signal that the market is beginning to believe that inflation has peaked, inflation is abating, so the Fed doesn't have to be so aggressive, and that would mark a huge change in sentiment in the markets. And a strong bullish rally would be in place once we see this 10-year yield starting to break down. So in the next couple of days, I expect a very strong rally in the S&P as well as the NASDAQ. So I'm going to show you how I'm going to set up a bullish trade using options, right? So first of all, I'm expecting a strong rally. Now, how high do I think it's going to go? Well, to kind of like pinpoint my target price, I'm using some Fibonacci levels. So first of all, if you take a look at the wider wave patterns, right? So we've got this wave down, wave up, wave down, and we're looking for the next wave up over here, right? We call this A to B, right? Wave down, B to C, wave up, next A to B wave down. We're now looking for the B to C wave up. Now, from the A to B, you can see that this is a Fibonacci retracement. And if I can draw this for you, I'm going to click on A, drag it to B, okay? And you can see very nicely, one more time, this is A, this is B, this is C. And usually it will retrace to the 50% or 61.8% Fibonacci level. So you can see this is the 61.8% Fibonacci level. So this is a classic 61.8% retracement. Now, once it retraces A, B to C, it would then go to the next wave down to the next A level, right? So how do we know that this is the bottom? Now, again, we can't predict for certain, but with Fibonacci, we can kind of like make some intelligent statistical guesses. So what we do with Fibonacci is we go to a Fibonacci extension tool, which is this one. And again, we click on A, go to B, go to C, and boom. You can see this is the 100% level. So usually after an A, B, B to C, it will then reach the 100% target, which is exactly where we are right now. So this gives me an additional pattern of confluence that this is the end of this wave pattern because it's at 100% level, or at least near the end, right? So the question is now, where is it going to retrace to? So once again, we apply Fibonacci. And let's see what we get, okay? So let's go back to our Fibonacci retracement tool one more time. A to B. So this becomes AB. All right, so we are looking at a target of 50% or 61.8%. So this is our target range of where we think the market is going to go, between 326 to 336, right? But to be conservative, I'm going to target to reach 326. And I'm going to show you how I can set up a trade to target that bounce in the triple Qs. So if I expect that there's going to be a strong bounce in the market, whether the SPY or the triple Q, how can I trade this? Now, what's very important to remember that as a trader, you can never be right all the time. I don't expect to be right all the time. So it's not whether you're right or wrong. It's how much you make when you're right and how much you lose if you are wrong. So whenever I set up a trade, I want to ensure that I always risk $1 to make more than $1. So I risk $1 to make $2. I risk $1 to make $4. So even if I'm wrong, heck, I lose just $1, right? But if I'm right, I make $2, $3, $4. So when you do that consistently as a trader, even if you're right half the time and you're wrong half the time, you are still profitable. So it's all about money management. It's all about controlling your risk to reward ratios and not just saying it has to go up. No, it doesn't have to go up, because the market, you can't predict it 100%. You can only look at what we call high probability entries. Okay, but you must always know when to cut loss and get out when it's not moving in the direction which you anticipate, right? So I'm going to show you how I swing trade using options. So I love to use options because with options, I limit my risk, but I have got great rewards. So again, I risk $1 to make $2, or I risk $1 to make $4. Many people, they just like to buy call options, but I don't, because I think if you just buy call options, they are very, very expensive. So I'm going to show you two methods that we teach in our classes. One method is what we call a bull call spread, and another method is known as a back ratio spread. And it's pretty interesting, pretty cool. So this is how it goes. So first of all, I'm going to start with a bull call spread. Now, what does that mean? That means I'm going to buy a call option just above the current price. So right now the price is at 289, right? Of course, when the market opens tomorrow, it could go higher, so I have to adjust it when the market opens, right? So I'm going to buy a call option just above that. So for example, I could buy a call option at say 293, for example, just slightly out of the money, okay? And simultaneously, after I buy the call option, I will sell another call option at my target price, which is about 325, 326, somewhere here. So over here, I will sell a call option at say 325. So why do I want to sell a call option and buy a call option? Because when I sell a call option, I collect money, I collect premium that will help to pay for the call which I buy. So this lowers my cost, makes it a lot cheaper than just buying a call option, right? So this is how I set it up. So first I have to decide on the expiration date. I'm going to just choose 30 days, which is a pretty standard for swing trade. So 30 days, and I'm going to look for 293, which is over here. And this is a call option. I'm going to go to 293, right click and buy vertical. Vertical means a vertical spread, right? So click on that. And there we are. I'm going to buy a call option at 293, right? And I'm going to sell a call option at my target price of 325. Let's look for 325. 325. Boom, there we go. Okay, so how much would this trade cost me? It will cost me $7.85. Now, one contract is 100 shares, so multiply by 100, that will be $785. So that's the total cost of this trade. And that's also the maximum loss. So the most I can lose is $785. All right. Now, if I click on this, you can see that my maximum loss is $785 if right, it drops and it expires worthless. But if it goes up to my target price, I could make a maximum profit of 2,415. So in other words, what's my risk to reward ratio? I'm risking 785 to make 2,415. So 2,415 divided by 785, I'm risking $1, right? I'm essentially risking $1 to make $3. So is that a good trade? To risk $1 to make $3? Not bad, right? If I'm wrong, I lose $1. If I'm right, I make $3, right? So again, if I can just do this a few times, even if I'm right half the time, I'm still very profitable, okay? Now, some of you could be thinking, but Adam, you know, I could lose 785. That's a lot of money for me. It's too big. So don't worry, I'm going to show you another technique in a while where it's a lot lower, all right? But for this one, it's 785 per contract. Now, what does the trade look like? I'm going to show you the profit and loss chart for this trade. Okay, so there we go. This is the profit and loss chart. Now, the date today is the 22nd of May. So if I enter the trade tomorrow, it will be the 23rd of May. I'm going to go to 23rd of May. Right, there we go. Okay. Now, so over here, you can see on the y-axis, we have the profit and loss. So this is profit. You make 500 bucks, 1,000 bucks, 1,005, right? Below zero, this is you're losing money. You lose 500, you lose $1,000, right? So that's the profit and loss. On the x-axis, you have got the stock price. So the current stock price is here, right? This is the current stock price, right? About 289, okay? My target price is for it to go to 325. That's my target price, okay? Now, if it drops below the recent swing low, I will cut loss. So my cut loss point will be at 275. All right, so over here, I cut loss. This is my profit target. And this is the current price right here. Right, now, so you see two lines. First, you see this green line. The green line is what happens at expiration. Expiration will be on the 21st of June in 30 days. So on expiration, this is how much I can lose and this is how much I can make, right? The purple line that you see is the profit and loss based on the date here, which is if I enter the trade tomorrow, this will be the profit and loss of this trade. Now, I'm going to assume that the market is going to move within the next about 20 days. I think within the next 20 days, the market is going to start moving up, right? So I'm going to shift this to about 20 days later, roughly. So about 10 of June, I'm going to put it to 10 of June. And notice what happens with the purple line when I go to 10 of June. Boom. You can see that it shifts down slightly, right? So I can see that if 20 days from now, if the market doesn't move, if it stays there, all right, if it stays here, do I lose money? Yes, I do lose money. How much do I lose? Now, take a look at this box over here and look at the purple number. Can you see this purple number here? Okay, so if I put my mouse here, if the price remains here, what does the purple box say? It says minus 494.59 or 495. So in other words, in 20 days, roughly about 20 days, if the market doesn't move, I will get out, right? And if I get out, I'll lose about $495. Let me write this down. I'll lose 495 bucks if the market doesn't move, right? Now, if the market drops to 275, I'm going to cut loss like I mentioned. So if I cut loss there, how much do I lose? Look at the purple line. I'll lose 756.86. So 757, right? So if it drops, I'll lose 757. All right. Now, what if the market goes to my target price? So market goes to 325, which is where I think it will go if the market rallies. So I will get this point. Look at the box 1991. Can you see 1991? Yep. So 1991 over here, right? So essentially, again, if I cut loss here, I lose about 700 bucks. If it goes here, I get about 1991, about close to $2,000, right? Of course, if it goes higher, I will get the maximum of 2415, right? If it keeps going up, I'll get 2415. Okay, so if you take a look at this trade again, I'm risking $1, right? So let's say I lose 757, but I could make this. Now, if I take 1991 divided by 757, basically I'm risking 1 to make 2.6 of my risk. If it goes higher, I make 3 times, right? So risk 1 to make 2.6, risk 1 to make 3. So is this a valid trade setup? Yes. So again, in trading, as long as you risk 1 to make more than 1, it's a good trade. And you don't have to be right all the time. You just have to be right more than you're wrong, and you'll be really profitable. So are there even better strategies than this? Yes, there are. Now, if there are enough of you who are interested and you leave your comments that you're interested to learn, I'll create another video to show you how we use a back ratio strategy, which is something that we teach in our options classes. Now, using the back ratio strategy, the cost of entering the trade is going to be a lot lower. The risk is going to be a lot lower at less than $200, and you can get a risk to reward ratio of 1:4 or even more. So once again, if you're interested, tell me in the comments if there's enough interest. I'll create another video to show you how to trade with even lower risk and higher reward using the back ratio strategy. So till then, may the markets be with you. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.